Welcome back to the deep dive, everybody. Today we're tackling a concept that's, well, pretty fundamental. We're talking about sound money.
Ah, yes. Sound money. A concept that, has a surprisingly long history and carries some pretty profound implications for all of us, really.
You got that right. It's fascinating to see how this idea of stable, dependable money has been viewed as like the bedrock for so many positive things.
Definitely. We're talking about fostering long-term thinking, encouraging people to save and invest, enabling the growth of capital, that kind of thing.
Exactly, and it really underpins both trade and individual freedom. You can't really have one without the other, right?
You can't. They're interconnected. But let's be honest, most people just want to understand this stuff quickly and thoroughly, without getting bogged down.
Right, without getting lost in a maze of jargon and economic theory. So we're going to do our best to distill the essence of sound money for you today.
Yeah, and thankfully we've got some great resources to draw from. We'll be looking at excerpts from the Bitcoin Standard, which gives us that historical and economic perspective on money.
Well, that's a great one. And we'll also be dipping into Mastering Bitcoin, which dives into, well, the more technical side.
The nuts and bolts. It examines a modern digital example of money, which is really interesting.
So the mission for our deep dive today is pretty clear. We want to understand what truly defines sound money, how it has shaped societies throughout history, and how something like Bitcoin, this digital thing, relates to these age-old principles.
Okay, I'm with you. Let's jump in.
Sounds good. Now, I guess we should start at square one. What is sound money?
Okay, well, the Bitcoin Standard offers a really interesting perspective, particularly the Austrian economic school of thought. They say sound money, it's not about a specific commodity like gold.
It's not just about shiny metals or anything like that.
Right. Instead, they argue that it's about money that emerges naturally, freely chosen by people in the market. It's like the money that wins out in a free market of ideas and options.
Makes sense. It's not something imposed top-down by any authority.
Yeah, exactly. Its value comes from, well, the actions of individuals as they use it.
Like a consensus almost. The market speaks, and that's what determines the value.
Interesting. And the book really emphasizes how technology plays a huge role in this whole process, right?
Oh, absolutely. The technological realities of any given time period have a massive impact on how easily obtainable or how hard different forms of money are.
So the technology available influences how easy or difficult it is to produce or acquire a certain type of money.
Okay, I see where you're going with this.
And this, in turn, affects how easily it can be exchanged, its salability, a key characteristic of good money, obviously. And then there's its hardness, which basically means how resistant it is to being devalued, how well it holds its value over time.
That makes sense. Something that's easy to produce tons of wouldn't be a very good store of value, right?
Right. Think of seashells, for example. They might have worked as money in certain places and times, but when advancements like, well, hydrocarbon fuels made them super easy to gather in massive quantities.
Well, they lost their value, didn't they?
They did. No longer scarce, no longer a reliable store of value. The Bitcoin Standard actually tells a fascinating story about the chiefs of Yap Island. They intuitively understood that easy money, it actually makes society poor in the long run.
Huh. They knew that flooding the market with something, even something like seashells, undermines the whole system.
Exactly. It's a pretty timeless lesson, if you think about it.
So you've mentioned this term hardness a few times now. Can you break that down a bit more? I mean, what does that actually mean when we're talking about money?
Sure. In simple terms, it comes down to this thing called the stock-to-flow ratio. The stock is the total amount of that money already in existence, and the flow is how much new money is being created or added over time.
So if something has a high stock-to-flow ratio, that means there's already a lot out there, and the rate of new creation is slow.
Exactly. Like, think of a rare antique. There's a very limited supply in existence, right? And very few new ones are ever made. This helps maintain its value over time.
It's hard to debase it. Makes sense.
It is. You can't just suddenly flood the market with tons of new ones and expect it to hold its value.
Right.
That's why the Bitcoin Standard contrasts this with easy money, stuff with a low stock-to-flow ratio. It's much easier to produce more of it, so it's susceptible to, well, devaluation.
I'm getting that antique versus common rock analogy now. One holds its value, the other not so much.
Exactly. Now, the other important thing to remember is that money, it doesn't just sit around. It plays a vital role in the economy. It has different functions.
Right, it's not just about hoarding wealth.
Yeah.
So what are those functions? The Bitcoin Standard lays out 3 primary ones, right?
It does. First up, it acts as a medium of exchange. It facilitates trade. It makes it way easier for people to exchange goods and services than bartering, which, let's face it, would be a nightmare in a complex economy.
Yeah, try bartering for groceries at the supermarket. So money greases the wheels of commerce.
It does. And secondly, as we've been discussing, it functions as a store of value. It allows you to hold on to your wealth and purchasing power for the future.
Which ties directly back to that whole hardness thing, right? If your money is constantly losing value, it's a pretty lousy store of value.
Right. You need some confidence that it'll be worth something tomorrow. And then the third function, equally important, is that it acts as a unit of account.
A common yardstick for measuring value, right?
Exactly. So you can compare the value of different goods and services. It helps us understand prices and make informed economic decisions. These three functions, they're interconnected and absolutely essential for a healthy, functioning economy.
Okay, I'm with you so far. Now let's unpack this idea of money as a medium of exchange a little bit further. How exactly does a sound medium of exchange help create larger, more complex economies?
So imagine a world without a widely accepted medium of exchange. You'd be stuck bartering, right? Trying to find someone who has what you need and wants what you have to offer.
Talk about a logistical nightmare.
A total nightmare. It would be incredibly inefficient. But a sound, universally accepted medium of exchange, well, it changes everything. It enables far larger and more sophisticated economies to develop.
Because it removes all that friction, all that back and forth.
Precisely. It allows for specialization. Individuals can focus on what they're really good at, knowing they can easily trade their output for, a huge range of other goods and services they need.
It creates a more efficient division of labor. Everyone benefits.
Yeah. The Bitcoin standard actually illustrates this beautifully with the example of, believe it or not, fishing. Think about how much fishing has changed, right? You've got these primitive methods from way back when, and then you've got these massive modern fishing operations.
So from handlining fish to these enormous factory ships, it's a pretty striking contrast.
It is. And that shift to this highly capital-intensive modern approach, well, it relies entirely on having a sound medium of exchange. You need to be able to pay the shipbuilders, the fuel suppliers, the crew, all these specialized roles, and they, in turn, need to be able to use those payments to buy what they need.
Without that common, trusted currency, the whole system would grind to a halt. Fascinating. Now let's shift gears and talk about sound money as a store of value. Why is that so critical, especially for the long-term well-being of a society?
Well, when money can reliably hold its value over time, it fundamentally encourages people to think beyond the immediate. They can save their wealth, knowing it's not going to be eaten away by inflation.
Instead of spending everything they earn today, they can invest in the future.
Yeah. Invest in things that will benefit them and society as a whole down the line. Things like building infrastructure, developing new technologies, education, all those things that require a long-term perspective.
It's like planting a tree whose shade you might not enjoy, but future generations will. That long-term thinking is essential for progress.
It really is.
Mm-hmm.
The Bitcoin standard calls this future orientation, and it's closely tied to the ability to save and invest with confidence. If money is constantly losing value, people are less likely to delay gratification.
Right.
They're more inclined to spend whatever they have now before it loses more value.
I get it. It undermines the incentive to save and invest for the future.
Exactly. And that can be a real drag on long-term progress. Now, we haven't forgotten about the third crucial function of money, the unit of account.
Right, that common measuring stick. How does sound money contribute to that?
Well, a stable unit of account is absolutely essential for making sound economic calculations. You need it for businesses and individuals to accurately assess profits and losses. You need it to make informed decisions about investments and really to have a clear picture of the economic landscape.
So it's like a stable foundation on which you can build all sorts of economic activity.
Exactly. But the Bitcoin standard makes a really important point. When the quantity of money is constantly in flux, which is often the case when governments control it and can just print more at will.
It throws a wrench in the works.
It does. It distorts that essential measuring stick. It becomes incredibly difficult to figure out the real costs of things. It can lead to all sorts of misguided investments. Imagine trying to build a house with a ruler that keeps changing length. It's just not going to work out well.
Okay, yeah, that analogy really drives the point home. So I'm really intrigued by this historical perspective. The Bitcoin standard takes us through this fascinating journey of money, starting with, well, the earliest forms.
It's a fascinating journey, for sure. Initially, people used all sorts of things as money. Seashells, beads, even livestock. But as technology advanced, particularly metallurgy, metals like gold, silver, and copper, they kind of rose to the top.
They proved superior in a lot of
Oh,
ways.
yeah. The book points out that these metals could be divided into these uniform, recognizable units. Plus, they were much more portable and durable than, say, a herd of cows.
Definitely. Imagine carrying around a bag of gold coins versus enough cows to buy a plot of land. Big difference in portability.
Huge difference. And, for a very long time, coins made from these precious metals, they were basically the main form of money across the world, weren't they?
They were, for something like 2,500 years from the very first recorded gold coins minted in Lydia to the early 20th century, gold, silver, and copper coins were the go-to for everyday transactions. It's an incredibly long period.
It is. Gold, in particular, became known for its salability across both time. It's incredibly durable, and space, its value is dense, so it's relatively easy to transport, even over long distances.
It's like this timeless, universal form of money.
Exactly. Silver was more practical for, medium-sized transactions, while copper or bronze handled the smaller, everyday stuff. And the fact that these metals were standardized into coins with, like, recognized weights and purities, that was a game changer for large-scale markets and international trade.
It reduced those transaction costs, made everything more efficient and trustworthy.
Yeah, and the beauty of gold in particular is that it can't really be faked. It's physically, chemically unique.
Okay, but the Bitcoin standard doesn't shy away from the downsides of these metal-based systems either, right? What were some of the big issues?
Well, the book points out two major weaknesses. First, the fact that multiple metals were often used as money simultaneously. Well, that led to all sorts of headaches with exchange rates.
Because the relative value of gold and silver, for instance, could fluctuate.
It did all the time, driven by shifts in their supply and demand.
Yeah.
Silver, especially. It went through periods of, well, kind of a declining value compared to gold.
Interesting. So it wasn't always a smooth ride.
Nope. And then the second weakness, which is probably more damaging in the long run, is this. Governments and counterfeiters, they were constantly trying to debase the coinage.
So they'd reduce the amount of actual precious metal in each coin.
Exactly. It was essentially a sneaky form of taxation, a way to chip away at the real value of the money.
Not so sound after all.
Right. This constant tinkering eroded public trust and, undermined the whole purpose of having sound money in the first place.
It makes you wonder how much damage that kind of manipulation has done throughout history.
It does.
Yeah.
But the book provides a really interesting contrast to that with the example of the Islamic dinar. It apparently maintained its integrity for centuries.
Oh, right. That's fascinating. So what was their secret? What made it so resilient?
Well, it's a remarkable story. Back in 697 AD, the Umayyad Caliph Abdul-Malik ibn Marwan, he standardized the weight and purity of the dinar.
Created a standard, reliable coin.
He did. And the amazing thing is that even as empires rose and fell around them, the dinar remained in wide use for centuries. It was respected. It even became deeply ingrained in cultural practices, like dowries.
It's amazing how a stable, reliable currency can outlast even powerful empires.
It really is. The Bitcoin standard actually contrasts the dinar's stability with the eventual collapse of Roman money.
Suggesting that there's a strong link between sound money and, well, a flourishing society.
Exactly. They argue that the erosion of Roman currency contributed to the decentralization of power and the rise of feudalism in Europe.
Interesting. So a sound currency can act as a unifying force, while a debased one can, well, contribute to fragmentation.
It's a compelling idea. The dinar's enduring stability really underscores this crucial point. When a currency maintains its integrity, it can outlast empires and become a core part of a society's fabric.
A powerful lesson for sure. Now, fast forward a bit and we get to the gold standard, which was the dominant monetary system for a while.
Right, the gold standard. It was designed to bring stability, by pegging national currencies to a fixed amount of gold. But as the Bitcoin standard points out, it wasn't a perfect system.
It had some built-in vulnerabilities.
It did. For one thing, it relied heavily on centralized gold reserves. These were held in banks and eventually central banks. And this centralization, well, it made those reserves susceptible to government control.
So susceptible to political pressures. Not ideal when you're trying to maintain a neutral, stable monetary system.
Right. And as more paper money came into circulation, much more than the actual gold backing it, governments faced this constant temptation to issue more unbacked currency, especially during crises like wars.
It's like spending more than you have, but on a national scale.
It is. And The Bitcoin standard makes a pretty strong case that this inherent instability in the system, along with the massive financial strain of World War I,
It ultimately led to the downfall of the gold standard.
it did. And that led to this rise of monetary nationalism, which was basically the end of an era of true global economic integration based on, well, relatively sounder monetary practices.
The book doesn't pull any punches in its assessment of what happened, so it seems like this move away from sound money had some major, long-lasting consequences.
It seems so. And the Bitcoin standard then goes on to explore the rise of Keynesian economics, which is really fascinating.
Oh, yes, the Keynesian Revolution. So what's the connection between that school of thought and the shift away from sound money?
Well, the book argues that the Keynesian school, which gained a lot of traction after the Great Depression, basically provided the intellectual justification for governments to get more involved in managing the economy.
Including controlling the money supply.
Exactly. They advocated for actively managing the money supply, which is a pretty big departure from the traditional sound money view, which emphasized letting the market determine the value of money.
So it was a shift from a hands-off approach to a more interventionist one.
Yes. And the Bitcoin standard suggests that this shift was partly fueled by universities becoming more integrated with government. They started promoting this idea of the state managing the economy and downplaying the importance of, free markets and those classical liberal economic ideas that had traditionally favored sound money.
Interesting. So it was a combination of intellectual and institutional shifts. But how did the real-world economy actually perform after World War II, especially in light of these new Keynesian ideas?
The Bitcoin standard actually points to the post-World War II economic boom in the U.S. as a pretty stark contrast to some of those Keynesian predictions, despite significant cuts in government spending.
Which seems counterintuitive to a Keynesian approach.
It does. But despite these cuts and the removal of wartime price controls, the U.S. economy experienced this phenomenal growth, a really smooth transition back to a peacetime footing.
So it seems like those Keynesian prescriptions weren't necessarily the magic bullet.
Right. And millions of soldiers coming home from the war were absorbed back into the workforce, contradicting the idea that high levels of government spending were essential for, full employment and economic output. It was a very different outcome than many had predicted.
Fascinating. So following that, the U.S. dollar became the world's primary reserve currency. This was a significant shift, right? What are the implications, according to the Bitcoin standard, of essentially having the entire world operating on a form of government-issued money?
It's a huge shift. And the Bitcoin standard really encourages us to think critically about the soundness of a system where the money supply is ultimately controlled by governments.
Because governments have their own incentives, which might not always align with maintaining a truly sound currency.
Right. They have this inherent temptation to, well, inflate the money supply to achieve their political or economic goals.
And that, of course, raises concerns about its long-term stability.
Exactly. It undermines its ability to serve as a truly reliable store of value and a stable unit of account. Remember those essential functions we discussed?
I do. And this was the first time in history that the entire global economy was basically anchored to a purely fiat currency system.
It was. And the book argues that this is a major departure from historical norms and, well, carries some inherent risks. Risks that we need to be aware of.
Okay, so this brings us to the concept of time preference, which the book explores in quite some detail. Can you explain how unsound money, especially with its tendency towards inflation, affects our societal time preference?
Sure. Time preference basically refers to how much we value receiving something sooner rather than later. It's like, would you rather have $100 today or $110 a year from now? That reflects your time preference.
And about delayed gratification.
Yeah. Now, the Bitcoin standard argues that unsound money, which usually leads to inflation, well, it actively discourages saving.
Because why hold on to something that's guaranteed to lose value over time?
Exactly. It makes more sense to spend it now while it's still worth more, or to borrow and buy assets that might appreciate faster than inflation.
Makes perfect sense from an individual perspective.
Right. But on a societal level, this leads to lower national savings rates and a general increase in debt.
People are more focused on the short term.
They are. And this shift in time preference towards the short term, well, it has all sorts of knock-on effects on economic decision-making.
So it's not just an abstract economic concept. It affects how individuals and society as a whole behave.
Absolutely. Now, this political control over money, it can have some other pretty serious downsides too, right?
Right. When the government has its hand on the monetary lever, so to speak, it can be tempted to, well, use it for its own ends.
Exactly. The Bitcoin Standard argues that when politicians are looking to get reelected, they often prioritize short-term spending initiatives. They want to please voters in the present.
But that often comes at the expense of the future.
It does. There's this great quote from H.L. Mencken that the book uses. Every election is an advanced auction on stolen goods.
Wow, that's a powerful image. It's like they're borrowing from the future to fund the present.
They are. It's unsustainable. And it gradually erodes the value of savings over the long term. Now, this might sound surprising, but the book even draws a connection between unsound money and a potential decline in artistic creation.
That's interesting. I wouldn't have thought of that connection.
It's a bit of a provocative argument, but they contrast the dedication and the meticulous effort evident in, say, the works of Michelangelo or Bach, who lived in periods with arguably sounder monetary systems. They contrast that with the, maybe more fleeting nature of much modern art.
So are they suggesting that unsound money leads to a kind of cultural short-sightedness?
In a way, yes. The argument is that unsound money encourages that focus on immediate gratification. It can actually reduce our willingness to delay rewards, our low time preference, which is often crucial for those long, painstaking creative endeavors. It's like, why spend years on a masterpiece when the value of everything is eroding?
Makes you think. So how does all of this affect capital markets and long-term investments?
Well, the Bitcoin Standard explains that unsound money really messes with capital markets by breaking the natural link between real savings and investment.
Okay, unpack that for me.
So in a healthy system, investment is fueled by actual savings, right? People set money aside. And that pool of savings is what banks use to provide loans for businesses and individuals to invest.
So investment is backed by real resources.
Exactly. But when central banks can just create new money out of thin air to finance investments, rather than relying on actual accumulated savings,
it creates a disconnect.
it does. And it leads to what economists call malinvestments. Those are investments that wouldn't be profitable in a truly free market based on real savings. They're essentially artificial, fueled by this easy money.
So it creates a distorted picture of where capital should be allocated.
It does. The book actually contrasts this with the relatively quick recovery from the Depression of the 1920s in the U.S. It argues that the recovery was so quick because the government didn't step in and try to prop up those failing malinvestments with more newly created money.
They let the market correct itself.
They did, which can be painful in the short term, but it ultimately allows for a healthier reallocation of resources. Now, the last concept I want to touch on from the Bitcoin Standard is this idea of bezel.
Bezel? That's a new one. What exactly is bezel?
Bezel is basically the societal cost of expanding the supply of unsound money. It's all those misallocated resources, the wasted human effort that goes into, well, making more money when it's not really backed by anything of value.
So it's the waste inherent in an unsound monetary system.
Right. Because fiat money isn't valuable in and of itself. It's just a medium of exchange and a unit of account. Creating more of it doesn't actually generate real value. And this bezel manifests in different ways. You get this proliferation of financial engineering schemes that don't create real wealth. You get zombie companies that only survive because of government contracts or artificially low interest rates, not because they actually provide goods and services that people want.
It's like a drag on the productive capacity of society. It reminds me of all that paperwork people have to do for taxes. That's a necessary evil, but it's not actually producing anything of value in itself.
That's a good analogy. It's the friction in the system. Okay, so we've spent a lot of time exploring this historical and economic backdrop of money, but I think it's time to bring Bitcoin into the conversation.
It is. So let's turn to mastering Bitcoin and dive into how this technology fits into this whole discussion about sound money.
Sounds good. Mastering Bitcoin makes it clear that Bitcoin isn't just a digital currency. It's an entire ecosystem. It's a collection of concepts and technologies that create a decentralized system for storing and transmitting value.
Okay, that's a helpful way to frame it.
And the really cool thing is that it's built on open source software. That means anyone can look at the code, can review it, can even contribute to it. That transparency is crucial for its trust model. And it's designed to be accessible to anyone, anywhere with an internet connection. No gatekeepers.
No central authority controlling it.
Exactly. And this idea of decentralized trust, it's really at the heart of Bitcoin. It's a very different approach compared to those traditional banking systems we talked about. Those rely on central authorities to manage everything and maintain trust, right?
They're the gatekeepers.
Yes. But Bitcoin, well, it achieves trust in a completely different way. It uses this distributed network of participants, and everyone operates under this very transparent, immutable set of rules.
So no single point of failure.
Exactly. Mastering Bitcoin actually makes this really interesting comparison to ant colonies.
And colonies.
Yeah, so individual ants, they follow these simple rules, but collectively, they create these amazingly complex and efficient systems. There's no central planner or leader, and Bitcoin is similar. Its network of nodes follows the rules of the Bitcoin protocol, and collectively, they maintain the integrity of the system. No need for a single trusted entity.
Okay, I'm starting to see how this fits into the sound money framework, but I think a lot of people are still unclear on how Bitcoin actually works on a practical level.
Yeah, that's fair. It can seem a bit mysterious. So let's break down how a Bitcoin transaction actually happens.
Let's do it. Walk me through it.
Okay, so let's say someone wants to send some Bitcoin to someone else. Their Bitcoin wallet, which is basically just software on their phone or computer, creates a transaction. It's basically a digital file with a digital signature, specifying how much Bitcoin they want to send and the recipient's address.
So it's kind of like writing a check, but digital.
It is, except way more secure. And this transaction, it's broadcast to the entire Bitcoin network, all those nodes we talked about.
And what happens to the transaction then?
Well, those transactions are collected by these specialized network participants called miners. They gather these transactions together and bundle them into blocks.
Blocks of transactions. Got it.
And here's where it gets interesting. The miners, they compete to solve these complex mathematical puzzles. It's called proof of work, and the first one to find a valid solution gets to add their block of transactions to this thing called the blockchain.
Okay, I've heard of the blockchain, but what exactly is it?
The blockchain is basically this giant public ledger, a record of every single Bitcoin transaction that has ever taken place.
So like a history book of Bitcoin transactions.
Kind of,
Yeah.
except way more secure. And it's not stored in one place. It's distributed across the entire network, constantly being updated and verified by all those nodes.
So that's how it's decentralized. And what about those puzzles the miners are solving? What's their purpose?
The puzzles, they serve a really important purpose. They make it incredibly difficult and very expensive for anyone to try to tamper with the blockchain. To change the history of transactions, you'd have to redo all those calculations, which requires a massive amount of computing power.
So the more computing power is dedicated to the network, the more secure it becomes.
Exactly. And the blockchain itself, it acts as this tamper-proof, auditable record. Anyone can go back and look at every single transaction that has ever happened, full transparency. And each block is linked to the one before it, creating this chain of cryptographic proof that makes it virtually impossible to change anything retroactively.
Okay, so that's how Bitcoin achieves security and immutability. What about those wallets you mentioned earlier? How do they fit into this picture?
Wallets, they're the interface between users and the Bitcoin network. It's basically software, or sometimes a physical device, that allows you to manage your Bitcoin addresses.
So your Bitcoin address is kind of like your bank account number, right?
Well, it's a good analogy. And each address is associated with these secret keys, which you absolutely must keep safe. These keys are like your digital signature.
They prove you own the Bitcoin associated with that address.
Exactly. And only you can authorize transactions using those keys.
Right.
So when Joe wants to send Bitcoin to Alice, his wallet uses his private keys to sign the transaction, and that's what proves to the network that he's authorized to send that Bitcoin.
And Alice's wallet uses her keys to receive it.
Exactly. Mastering Bitcoin even has this example of, Joe sending Bitcoin to Alice using his phone and just scanning a QR code. Super simple and user-friendly, but backed by this incredibly complex, secure system.
It's amazing how accessible they've made this technology.
It really is. Okay, so we've covered a lot of ground here. I think it's time to tie it all back to our earlier discussion about the principles of sound money based on the Bitcoin standard. How does Bitcoin stack up?
Right. Does it embody those principles?
Well, it does in several key ways. First, Bitcoin supply is both fixed and predictable. It will never be more than 21 million Bitcoins in existence, ever. That limit is baked into the software. It's not something that can be changed.
So no inflation, no central bank printing more at will.
None whatsoever. And the rate at which new Bitcoins are created, that decreases over time through these pre-programmed events called halvings.
Halvings.
Yeah. Basically, the reward that miners get for adding blocks to the blockchain, it gets cut in half roughly every 4 years.
So new supply gets tighter and tighter.
It does. And this predictable, disinflationary supply schedule gives Bitcoin that incredibly high stock-to-flow ratio we talked about earlier. The Bitcoin standard, actually.